Hi-ho, everybody. Thanks for your patience. I apologize I'm a minute late in getting this launched, but appreciate everybody being here. If you are live on Facebook, welcome. If you have questions, please feel free to post them into Facebook Live, and I will do my best to get to those. But for those of you who are on Zoom and you have questions, I will be watching the Zoom chat a lot more carefully than I will be watching Facebook chat. So for those of you on Zoom, you get the benefit of having a little faster responsiveness from me. Anyway, let's go ahead and dive in because I squandered a minute in getting myself set up here. So let's talk. What we're going to talk about is really a rate update, kind of what's going on with the economy and how it impacts how the presidential election and some other things that are going on are going to impact interest rates and where they're going. So let's start with a market update. We've got rates here going back, and let me turn on my wonderful little pointer. Here we go. All right. So this chart up is good. The up numbers are better for interest rates. So the higher this goes, the lower interest rates are. This goes back right here to June 30th. And we saw the market get better in July, got a little worse in August, better in September, got worse through September, up a little bit, and then worse in October. So the mortgage-backed securities prices are back down to where we saw them back at the end of June, which are still in really, really good levels, but it's been a lot of volatility, especially recently heading into the election and the concerns that are coming up with the unknowns of what's going to happen with the election. So I want to give you a little bit of perspective to what this looks like in the longer term. This goes back to the middle of last year. So September is a year's view. So this is the end of last year. We've got rates that are around this level. Again, low is bad for interest rates. As it goes up, that's better. We saw what we thought were the best interest rates ever in January and February of this year when we got rates down to 3.25%. And that's really the best that we'd ever seen. Then we saw huge volatility. We saw rates get better and continue getting better, and now we're a little bit worse off. But big picture, we're still better than we were in the second quarter. So between March and June, rates were worse than they are today. So overall, we're still in great shape when it comes to interest rates, but we're going to see a lot of short-term volatility, especially over the next month. And that's really what we're seeing right here. So let me dive into the specifics of what is the election going to mean to interest rates. So the first thing I want to draw is a comparison to 2016. If you were in the industry in 2016, you would have seen what this chart is showing. We had rates that were at the end of 2015, fourth quarter of 2015, rates were around 4%. And then they started going down a little bit. And by February, they had bottomed out to around 3.75, came back up to about 3.9. And we saw a lot of movement until June. This is where Brexit came in. So you had the Brexit vote, Britain decides to leave the European Union, and that creates major upheaval in the market, and rates drop significantly the first week in June. So that was the first huge drop in interest rates that we saw in 2016. And then they stayed in a pretty low channel up and down a little bit until October. Rates moved up some in October, kind of like, and again, these are 30-year fixed rates, so up is bad on this chart. And so we saw rates move up some in October, kind of like we saw in the previous chart where things got worse in October. But what happened was right before the election, they got a little better. And then you've got election night. And election night rates skyrocketed. And literally I remember it being within like 5 trading days, within a short week, we went from a 3.5% interest rate to a 4.25% interest rate. And then by the middle of December, we were around 4.4%, dropped back down, and we were tinkering in the 4% range for the next 6 months. So this is the biggest fear because this is the most recent presidential election. And I've had a lot of people ask me, John, do I think this is going to happen again? Before I answer that, let me show you the bond market did exactly the same thing. So you have 10-year treasuries doing the same thing in 2016 where they had come down, they shot back up right after the election. Why did rates go up in 2016? Here's why. Because people expected interest rates to drop if Trump beat Clinton. The reason why is because it was uncertainty. Nobody knew what to expect from Trump, and uncertainty is bad news for the stock market. And so people pull money out of the stock market, and where do they put it? They put it in the bond market because bonds are considered to be a safe investment. So that money is pulled out of the stock market and put into the bond market. Everybody predicted that if Clinton won, rates would stay stable, maybe go up a little bit. If Trump wins, rates are going down because the market is going to be very, very uncertain, and that's good news for bonds. That's not what really happened. It was around midnight on election night, so that's going to be tomorrow night, after the results are in and people started seeing, hey, it's pretty clear Trump's going to be the new president. But more importantly, is it was clear that the Republicans are going to have unified control of the House, the Senate, and the presidency. And with unified control meant a tax cut was all but guaranteed. And we were going to have lower taxes were going to be good news for stocks because companies love lower taxes. They have higher profits. And anything that's good news for stocks is bad news for bonds and mortgage rates. So it wasn't the presidential election that made rates skyrocket. It was the fact that the Republicans were getting complete control of the presidency, the Senate, and the House, and they were going to have a much easier time passing the things that they wanted to pass, specifically a tax cut. Could we have a repeat of that in 2020? We actually can. Now, I'm going to be super clear. I should have made this clear when I started this. I do not want this to be a political conversation. We all have different political views. I'm not going to share my political views. I'm not asking you to share your political views. All I'm telling you is the facts as they stand, and the facts are super clear. The Democratic Party has a shot at unified control. They have a chance to take over the House, the Senate, and the presidency. If they do, we can expect to see two things. We can expect to see big stimulus spending. We can expect to see a change in tax policy. And a change in tax policy, you can read AKA an increase in taxes. So sure, rates can absolutely freak out if this happens, but the pandemic has really hampered the growth of the economy. And there is no way, in my view, that rates are going to shoot up anywhere near as high as they did, even if this came true. But the biggest trifecta of bad news tomorrow is going to be if there's a Democratic sweep. If the Democrats take the House, the Senate, and the presidency, then we can expect the stimulus spending, we can expect tax hikes, and that's going to be bad news for interest rates. But I don't think it's going to be anywhere near as bad news as we had in 2020. Stimulus, they're going to print more money. They're going to be issuing more bonds because that's where they get the money from. So they're issuing more treasury bonds, and that's going to cause a stronger economic recovery, which is great. But the stronger the economic recovery, the better the stock market is going to react. And those things, printing more money and a strong economic recovery, are bad for interest rates. But we can also argue the other side, which is tax hikes are bad news for the stock market and therefore good news for mortgage rates. Exactly the opposite of what happened in 2016, where they said tax cuts were going to be the outcome of unified Republican control, and that caused rates to skyrocket. Tax hikes will be the outcome of unified Democratic control, and that will cause the stock market to have a negative reaction, should cause the stock market to have a negative reaction, which is good news for interest rates. So what you have is you have competing interests, competing issues that even though the stimulus is going to drive rates up, the tax hike is going to drive rates down, and the pandemic, the overall challenge with the economy, is continuing to put pressure on rates to stay low. So do I think that on Wednesday morning we could wake up with higher interest rates if the Democrats sweep the election? Yes, I think we could. Do I expect it to be anywhere near as bad? And by the way, I'm not saying I expect that to be the outcome of Democratic win, but if that were the outcome, I don't expect it to be a very significant increase. And I think that increase will be tempered. And by the time we hit the end of December, we're going to see rates likely back down to where they are today. I don't see it being anywhere near as nasty as what we saw in 2016. But here's the other thing I want you to look at. There's a lot of movement. So this chart up is bad, okay? So this is the 10-year treasury. And what's interesting is the person who created this talked about the volume increases at the end of the month. have created essentially a shift in momentum every single month for the last 4 months. So you've got July where rates are getting better. August, rates get worse. September, rates got better. And each of those times, the shift coincided with a huge spike in the amount of dollars that were being traded in mortgage securities, or in this case, 10-year treasuries. And the same spike happened last Friday. As a matter of fact, it was a bigger spike last Friday, the 30th, than it was at any other point in the last 4 months. And rates had gone up across the board in October. And there's an argument to be made that we're going to see November's numbers looking better, and we already are. This was as of this morning. The 10-year treasury is coming back down. So we saw it go up on the 30th, and we've seen it start to come down right now. So there is a good argument to be made that November is at least starting out to point in a promising direction for interest rates, and the Fed is doing everything they possibly can to continue driving those rates down. Here's the bottom line. I absolutely expect uncertainty this week. We've got election day tomorrow. We've got the hangover on Wednesday of everybody freaking out about what does that really mean? What in the world happened yesterday? What if it's a contested election? What if we don't know by Wednesday? There's people that are arguing that we might not know for a month who won the presidential election. So there's a lot of factors here that are going to create uncertainty. Generally speaking, uncertainty is good for interest rates because the stock market does not like uncertainty, but we're going to see volatility. We're going to see one news media saying, oh, it thinks this person's going to win. Another news media saying, we think this person's going to win. And depending upon what news media outlet you subscribe to, you're going to react in a different way. But that hangover recovery day I'm concerned about on Wednesday, that's really, we're going to see the first impact of what the election day results are going to have on interest rates. Thursday is the Fed announcement. So the Fed is meeting on Wednesday and Thursday, and they're going to be having an announcement on Thursday. There'll be a lot of people reading into the tea leaves of what the Fed is thinking, especially if we know who the president is going to be next year. The Fed is going to be looked at as how are they reacting to the presidential election? Are they tipping their hand at all to what their future monetary policy is going to be, depending upon who won the election tomorrow? And then Friday is the monthly jobs report. So we've got another big question there in the jobs report about how good is the recovery going? Are we really seeing a strong recovery, or is the recovery petering out? What's happening with the second, third wave, whatever waves you talk about? We've got a number of cases that are significantly increasing. That concern puts pressure down on interest rates as we have more concern over this virus and this pandemic not being as solved as everybody thought it was. So overall, I don't think we're going to see a huge rise in interest rates. The economic uncertainty and the pandemic itself, I think, is going to temper any pressure for rates to go up. But I got some super, super good news that's kind of on a different front, and this has to do with mortgage coupons. So I explained mortgage coupons back, I don't know, March or April, when we were talking about how mortgages are bundled together into one coupon rate, and they're in 0.5% increments. So in April, I had told you guys we were super excited that the 2% coupon was starting to trade actively. And so there's a 2% coupon, there's a 2.5% coupon, there's a 3% coupon. And the 2% coupon, that's the rate that Wall Street earns. That means that there still has to be built-in margin, built-in profit on top of that rate to pay for the servicer, the person who is collecting the mortgage payment and keeping a little bit of that money for themselves. Therefore, the rate on a 2% coupon has to be no less than 2.25% to 2.75. The 2.5% coupon goes from 2.75 to 3.25%. So there is a floor right now for 30-year fixed interest rates that cannot go below 2.25. It doesn't mean that you can get 2.25 at a good cost. You might pay a pretty penny in fees to buy down to that interest rate, but the truth is the lowest rate you can get on a 30-year fixed right now is 2.25. that's more likely to be present in a government loan. That would be FHA or VA. Not so likely to see that low of a rate on conventional. Most conventional 30-year fixed is about the bottom is 2.49 or so. But here's what happened last week. Well, I missed what happened a month ago, is they started trading the 1.5% coupon. So the 1.5% coupon allows for 30-year mortgage rates as low as 1.75%. So a month ago, that coupon started trading, but last week the Federal Reserve started investing in that 1.5% coupon. That is a vote of confidence from the federal government, who's the biggest buyer of mortgages, that this coupon is likely to be here to stay. In other words, they think rates are moving down and they're buying rates at a lower level than what they were buying mortgage rates previously. That basically says the new hard stop on 30-year rates could become as low as 1.75%. Again, don't read that into, I want a 1.75% mortgage. I'd love to have a 1.75% mortgage too. But the fact is, there are hard stops on how low a rate can go. Currently, the hard stop is now transitioning to be at a 1.75%. Let me give you a little more detail. I'm going to stay really high level on this, but I want you guys to kind of get a better understanding of how all of this works together. So what you're looking at here is you're looking at, hold on one second. You're looking at the difference in a coupon and what it pays, what its value is. So what happens is over time, a loan that is at a 2.5% return on investment to Wall Street is worth more money or worth less money. That's how bonds work. All bonds are a fixed interest rate that you trade to somebody else saying, hey, I've got something that's going to earn 5% per year over the next 10 years. What's it worth? That's worth a lot of money. I got something that's going to earn 1% interest over the next 10 years. What's that worth? That's not worth very much. That's how mortgage coupons work. What you see, though, is high rates move lower because a lower coupon becomes the more favorable rate that the market likes. And so the value of the 2.5% coupon has been dropping, but the truth is the value of the 2% coupon has been staying pretty steady. That has rates moving into the 2% coupon being the most commonly used rate delivered to Wall Street, which means that the rates that is encompassing are market rates between 2.25 and 2.75. And that's what we're seeing. A lot of purchase transactions are hovering in that range, 2.5 to 2.75. Refinances, most companies have some form of a markup on there. The federal government added a markup onto refinances, so we're seeing refinances at maybe 2.8 to 2.9%. The same thing is happening with the new 1.5% coupon. The 1.5% coupon just started trading in September, and it kind of didn't know where its foothold was going to be, and now it's getting more favorable. It's getting stronger, and now if we sold a loan into this coupon, we'd get paid the face value of that loan plus 1%, which is exactly where the 2% coupons were. So if you did a loan back in April into the 2% coupon, the lender would get paid by Wall Street the face value of the loan plus 1%. Well, now we're getting plus 3% on that. And that's really where the between 3 and 4% return is what a bank needs to earn to make that a average market interest rate of the day. So I don't want to overcomplicate this. All I'm telling you is, guys, the 1.5% coupon right now looks pretty darn close to what the 2% rate coupon looked like back in April. So this is where I could see that we could theoretically move the play this out over the next 6 months that has a I'm laughing because somebody just texted me saying, hey, John, good job in not stating your political views, but I see that you're wearing a blue shirt. I did not pick my color of shirt based on my political preference today. I'm not telling you that it does or does not accurately reflect my political preference. All I'm telling you is if you look at the screen, the header of the screen is red. So I have, for that unnamed person who just texted that to me, I've got more red on the screen and more blue on my body. So therefore I am equally not tipping my hat to what my political persuasion is. All right, bottom line is, guys, this is pointing towards interest rates going down by another 0.5% in the next 6 months. The market is open to that possibility. That is super, super good news. So I wanted to be brief today. I wanted to cover a lot of high-level information. So at this point, I'm opening it up to questions. But what I'll tell you guys is we're going to have uncertainty. We're going to have unknown volatility, just like we've seen in the stock market last week. If we're talking about locking interest rates when people are purchasing homes, we've just got to lock it when we've got it. And rates are super good. They're still going to be super good. If they're up a little bit, how do we know if you wait 2 weeks if they're going to come back down? You don't. You just have to lock it and close your eyes. If you're refinancing, I'm talking to a lot of my clients about the fact that, hey, we're going to have to play with this as it goes. We could have super good news. Interest rates could come down a lot this week. We could have some bad news and they'd go up some. I don't think ultimately we're going to see a big shift in rates up at all, but I think we have to be nimble and we have to be willing to play it by ear. So people who are refinancing, this is the time that we say, hey, we postponed locking until we got to the end. And if it happens, we're getting to the end right now, maybe we postpone a little bit longer to see where it plays out. But first, let's talk about what the numbers are today and see if it's worth locking in depending upon what the election turnout looks like and kind of where the market ends up going from there. So if you have any questions, feel free to post them into chat. Otherwise, guys, I'll give you 7 minutes back into your day. Hi, Randy. Thanks for the shout out there in the chat. Guys, if you have any questions about this or anything else, please give me a call. We're still got great turn times on purchases. Most of our purchases are closing anywhere from 21 to 30 days. I know there's other lenders that are taking a lot longer than 30 days to close their purchases, but we're very much prioritizing our purchases. Be aware that appraisals are taking longer in a lot of markets. So I've got some appraisals that are taking sometimes 2+ weeks to get done. All right, Randy, you had a question. You see values, you missed the beginning. How dare you miss the beginning, Randy? I see values are going up by 7%. What happened to the foreclosures? That's a great question. So here's what's happening right now in my view of the foreclosures. I believe that, first of all, anybody who's having a hard time making their mortgage payment today, they're in forbearance. And forbearance gives them a year of no mortgage payments. So if you're having a hard time, if you have been impacted by COVID, if you haven't been impacted by COVID, but you choose to lie and say that you've been impacted by COVID, the bank has to give you a forbearance, and that forbearance can last up to a year. And at that point, the bank has to take all of those payments for that year, package them up and put them at the end of your mortgage, and you get to start fresh a year from now. I believe a lot of people can bank some of that money that they've been saving for the year and buy themselves another year or so of mortgage payments because they haven't had to make a payment for a year. Hopefully they're saving a little bit of that money to help them get through once they have to start making payments again. And I think we'll start seeing the economy start to recover, and we'll start to see those people get jobs back, and they won't in fact lose their home. More importantly, what I think we're going to see next summer, between next spring and next summer, is some of these people, now they have to start making their payment again, they won't be able to. They're going to have to sell, but they won't be foreclosures because they have equity in their home. We are at an all-time high in home values, especially relative to the mortgage balance. Unlike when we had the crash in 2006, 7, and 8, where we had everybody was a domino effect of, hey, I can afford my monthly payment, but oh wait, my payment went up because I'm in an adjustable rate mortgage and my value's gone down, which means I lose my home. And me losing my home causes values to drop even further. And now my neighbor can't refinance their home either, and it became the domino effect. We're not going to have that domino effect this time, Randy. So what you're seeing or what you're feeling that you're going to run into in foreclosures, I don't ever see it happening this cycle because we're still at the peak of values and we don't have people that have adjustable rate mortgages. If the people can afford their payment, they're going to continue to pay it. And this cycle, this economic downturn, it impacted mostly people at the lower end of the wage scale People who are middle to upper income earners did not get harmed anywhere near as bad during this pandemic. And that has kept that segment of the mortgage market, that segment of homeowners, strong in their repayment. And the forbearance ability has postponed anybody who was going to lose their home this year. I think anybody who has to sell their home next year because they don't have a job and they have to start making the payment again is going to be absorbed by the demand as long as rates stay low. If rates start going up, demand is going to drop. Now we might have an issue with some foreclosures. But if rates stay low, and I'm going to try and piece this together really, really simply. If rates stay low, it's because we are still dealing with economic issues. And therefore, people still don't have a job. Therefore, those people are likely at risk of having to sell their home in a distressed sale, but not in a foreclosure sale. If that happened, there's still going to be strong demand. If rates go up, we're not going to have as much demand on the buy side, but rates go up because the economy has strong footing and people are back to work. And if people are back to work, then those homeowners that were going to have their home foreclosed upon or at risk of that and instead sold as a distressed sale, they have jobs again. They don't need to sell. They can keep their home and happily have skipped a year's worth of payments and been able to make it through this downturn. So I don't see a big foreclosure crisis looming. I know some people say they do, but based upon what I see, I don't see it happening. All right, guys, if there aren't any other questions, I'm going to go ahead and let you go. Thank you for your time. Don't forget about me as you have buyers that are looking to get qualified. My team and I are looking forward to taking great care of you and your buyers, and have an absolutely amazing week. And we'll see you in a week when I'll tell you who I voted for. I'm not going to tell you who I voted for, but you can come back just in case you think I'm going to tell you. Guys, have a good week. We'll talk to you later. Bye.